Joining us, as we said, Charles Schwab, Chief Investment Strategist Sonders. Lizanne, good to see you. Important week.
Good to see you. Thank you.
Yep.
Yeah, a very important week.
Your thoughts about going into tomorrow and what the market's done, say, over the last 10 sessions?
Yeah, so I think the Fed does cut by 25, but perhaps in light of stronger consumption numbers, it wouldn't be surprising to see what is often deemed a hawkish cut, given the commentary we could hear from Powell, not necessarily telegraphing additional cuts throughout the rest of the year, maintaining that data dependency approach. In terms of market behavior, I think a lot of it has been based on the prospects for easier monetary policy, and maybe importantly, the fact that we haven't seen a move higher on the long end. We just have to remember just less than a year ago, actually, when the Fed had embarked on a 100 basis point campaign of cuts. Over that same period of time, you saw the 10-year go up by 100 basis points. So I think the relative calm in the bond market out the maturity spectrum is another reason fundamentally why the market has done well, and what has also given support for small cap stocks. What I would say we're likely to see, though, is a continued widespread in terms of things like the summary of economic projections and the dots plot, and maybe even a descent. That's been kind of par for the course in recent FOMC meetings.
As much as I hate the dots, you think that's going to be a market mover? So the expectation now is that they'll put in 2 dots for this year, so 2 cuts in Fed expectations. The market is now basically 100% priced for 2 cuts and 62% priced for 3 cuts. So is this going to be a disappointment?
I don't think that if the median dot is around what was expected, that is going to be market moving. Again, I think the range maybe is what's important, especially given concerns about threats to Fed independence and, some new voices coming into the mix. I think a continued wide divergence just would be suggestive of ongoing uncertainty. That means the members of the Fed, the voting members of the Fed, haven't sort of gelled on one forecast for either where the Fed funds rate is going to be or what the background economic conditions are.
Do you think the Fed, you just raised the Fed independence question, do you think that's really having an impact, or market participants are really worried about this? Stephen Myron is going to go in as a Fed governor, and people are thinking, oh my God, it's like the Fed is going to lose independence. He's a Harvard-trained PhD economist who is taking a leave of absence for the White House to do a very temporary role. I mean, I think he's going to fit in there just fine, even if he does want lower interest rates, as the president has advocated for.
I think there's this broad general worry. I do client events, Sarah, all the time. And lately, one of the top questions is about Fed independence. So I think that there is this embedded worry, but you're absolutely right. It's not yet impacting markets. The bond vigilantes haven't come back in droves. You're not seeing that push up on the long end, suggesting that kind of uncertainty. So I think ultimately the markets would be the ones to share any real concerns about dislocations coming by virtue of perceived or otherwise threats to Fed independence. So it's there. It's almost like the debt and deficit concern. It's not really having an impact on market behavior, but I can say that it's very top of mind in terms of investors and what's on their radar screen.
Meantime, we're watching Eurodollar 118. You got to go back to September of 21 for that. We've heard some commentary out of Lagarde that maybe the disinflationary trend over there is coming to an end. Do you think that eventually migrates our direction?
Well, I think to really pick up the truth behind the inflation readings requires going pretty deep below the surface of the headline numbers month over month or year over year, regardless of which inflation metric. I think you have to look at goods versus services, core goods, the goods category specifically impacted by tariffs. And Sarah made a good point earlier in talking about retail sales and where there was more strength than what was expected. But retail sales is a number expressed in nominal terms. I think we also have to look at a lot of this economic data in real terms, because what we saw in the past month or so, notwithstanding today's stronger reading on retail sales, is not a huge surge in the inflation rate associated with those goods that are directly impacted by tariffs, but declining demand in those areas. And that's the type of data I think we have to pay most attention to. It's sort of the fine-tooth comb you have to take through the inflation readings, the economic readings, the consumption readings, and to try to get that detail level analysis specifically tied to the policy impact, especially with regard to tariffs.